Let us see the next question. Mr. A has a portfolio of rupees 5 crore consisting of the equity shares of X Limited and Y Limited with a beta of 1.15. So overall beta is given to us. So definitely it must be the beta of the portfolio. Other information is as follows. Spot index futures is 21,000. Multiplier is 150. You are requested to reduce the beta of the portfolio to 0.85 and increase the beta to 1.45 by using change in the composition through risk-free security and say with the index futures. That is a question. So in the A part of the question, we have been provided that say how can you use the risk-free security for the purpose of say changing the risk to this. So for 0.85, I want you to do both the answers. Then I will do. So write down heading reducing beta of portfolio to 0.85. For that, it is A. Change the composition through risk-free security. So in that, what we will do, friends? Working note number 1, calculation of proportion of funds to be transferred to RF, risk-free security. So security or investment, in that say it is existing portfolio and it is risk-free security. Weight Wx, this is 1 minus Wx. Beta 1.15 and 0. Weight into beta 1.15 Wx and this is 0. Overall beta of the portfolio should be 0.85. Now we'll compute the Wx as balancing figure. So over here we understand 1.15 Wx plus 0 is equal to 0.85. So Wx is equal to 0.85 divided by 1.15. So the answer comes to 0.7391. Yes. So we understand that say the WRF is equal to 1 minus Wx, 1 minus 0.7391. That comes to 0.2609. So we can say that say approximately 26.09% of your existing investment should be transferred to risk-free security so that the beta of the portfolio will reduce to 0.85. So we understand that the amount of investment to be transferred to RF is equal to rupees 5 crore or 500 lakhs into 0.2609. So the final answer comes to 130.45 lakhs. This is the way we are supposed to make the calculation of answer. Now the same thing, that is, in order to reduce the beta of the portfolio to 0.85, there is an alternative method. And the alternative method is you enter into the transaction for sale index futures. So it is B. Sale index futures. So in that case, what will happen? We understand that say value of the portfolio into beta of portfolio minus beta required, whole divided by futures index value into lot size. Unfortunately, the futures index value is not given to us, so we have to use the spot index value. What is the value of the portfolio? It is an amount of rupees 5 crore, that is 500 lakhs, into beta is 1.15 minus beta required is 0, whole divided by spot index value, that is 21,000 into 150. So what will happen? 500 lakhs into 1.15. So 575 lakhs. Divided by 21,000 into 150. That comes to rupees 31 lakh 50,000. So the final answer is 18.29. Oh, I'm sorry. The required beta, I mentioned it wrongly. The required beta is 0.85. So 1.15 minus 0.85. So 0.30 into 500 lakhs. So it is 150 lakhs. That comes to 4.76, or we can say let's say 5 contracts, because the fraction number of contracts cannot be entered upon. So you will enter into the 5 contracts for the purpose of hedging. That is what we understand. The heading required beta 1.45. So in that case, we understand like this. Again, existing investment and a risk-free security. This is X. And friends, over here, it will be 1 minus X. Because the total is of course going to be 1. Amount. Sorry, beta. This is the weight, beta. This is 1.15 and this is 0. Weight into beta. So 1.15x and this is 0. And dear students, the beta of the portfolio has to be 1.45. That is provided to us over here. 1.45. So now we understand that 1.15 Wx or x plus 0 is equal to 1.45. So x is equal to 1.45 upon 1.15. That comes to 1.2609 once again. Okay. So now friends, we understand, say the weight of your existing portfolio should be 1.2609. Like that's the kind of answer which we are getting. So now we understand like this. Listen carefully. Basically over here, Mr. A has 2 alternatives for the purpose of increasing risk. What he can do, he may borrow at the rate RF and invest in existing portfolio. What he can do, he can borrow and he can make investment. And with that, so the risk will increase. This is what say he is required to do. Amount of borrowing is 500 lakhs into 0.2609. That comes to rupees 130.45 lakhs. This is what say you are required to do. I am giving you further explanation. What will happen? Existing portfolio and a risk-free security. The amount that you have borrowed is 130.45 lakhs and the investment in the existing one will be 500 lakhs plus 130.45 lakhs. So it would be 630.45 lakhs. This is what you will have. Now, this is the amount of investment. Now wait. Friends, what will happen? Your own investment is only 500 lakhs. So the weight is supposed to be calculated as 630.45 upon 500. This is again the point which is covered in the portfolio management. So this is 1.2609. This is negative 0.2609. Because for risk-free security, you have a short position in the cash market. You are borrowed. Borrowed means you are having a short position. Multiplying with the beta, this is 1.15 and this is 0. Weight into beta, so it comes to 1.45. And with that, so the overall beta of the portfolio will be 1.45 as you desire. This is what say you are supposed to do. This is the first alternative that say Mr. A has. So you can borrow and you can invest, or otherwise what you can do, sell a certain portion of your investment, comma, borrow that amount once again at the rate RF. So what you can do, friends, the other alternative is that say you may sell a certain amount of your portfolio, and again that amount will be say borrowed at the rate of RF, and it will be borrowed in such a way so that say overall risk of your portfolio will be say 1.45. This is what say you have to do. So if at all you are doing like this, then in that case how your beta of the portfolio will be 1.45. I explain that to you. Existing portfolio, risk-free security. Dear students, this will be 500 lakhs. Because what you have done, you have sold a certain amount of the portfolio. Again, you have borrowed, say, certain amount, that is, say, that amount itself, and you have invested. Let us say that you have borrowed an amount equal to X. So, your own investment will reduce to 500 lakhs minus X. Your weight. We know, friends, that say your weight should be 1.2609 and this should be negative 0.2609. This is what say we know. So over here we understand that say the answer is going to be like this: 500 lakhs minus X. That is the amount. So we are required to make the computation like this. 500 lakhs is the existing portfolio, negative x is the RF. So this is 500 lakhs minus x. The total is 1 and its internal bifurcation is like this. So 500 lakhs divided by 1.2609. So this will become 396.54 lakhs. This will become 103.46 lakhs. And this is 500 lakhs. So what will happen, friends? An amount equal to 103.46 lakhs, that amount of the investment you will sell from your existing portfolio, the same amount you will borrow and you will invest in the existing portfolio. And this amount that you borrow will be at the rate of RF. That is what we understand. So now you keep again the beta. This is 1.45 and this is 0. So weight into beta. So 1.2609 into 1.45, sorry, into 1.15 is 1.45. This is the way the beta of the portfolio will be 1.45. This is what we understand. What you have done, out of 500 lakh rupees of your portfolio, an amount equal to 103.46 lakhs is the amount of the investment that you have sold. That amount is withdrawn by you, say, from the investment itself. Now, this amount is borrowed by you at the rate of RF, and again you make investment in the existing portfolio. So your existing portfolio value will become 500 lakhs, but your own investment will be only 396.54 lakhs. And accordingly, say we are having the beta of the portfolio as we desire, that is 1.45.